Good morning, Mr. Grant Fagerheim. Thank you very much for doing this. I really appreciate your time.
Yeah, you're most welcome. I look forward to it. Thanks very much, Trevor.
For the listener, you are the CEO of Whitecap Resources, but what is Whitecap Resources?
So that's interesting that we talk about Whitecap Resources. Today, we're a Canadian oil and gas dividend-paying growth company, currently producing about 370,000 BOE per day, 62% oil and liquids, 38% natural gas. And included in our mix is our ownership of the largest carbon sequestration project in the world, that Weyburn, Saskatchewan. So we target annual growth between 3 to 5% per share per year, with a sustainable and predictable dividend at 73 cents per share annually. And we employ about 1,100 people, 540 people in the office and 560 people in the field. And our people are our key, or we call our special sauce, to driving the success of the company. So kudos to them for where we've come to at this particular time. But that's where we're at as of now.
From our context, the market cap of approximately $13 billion as of today. And like I think you said, number 5 natural gas producer in the country. So company's grown quite a bit.
Yeah, it has. It has through a combination of, and I can use this, organic growth as well as many acquisitions. And we'll talk a little bit more about some of those as we walk through.
You also have a great corporate presentation. I have it here with me. A lot of the ones in the sector seem to look like confetti versus the Whitecap one, which is very clean and simple. So should have to give a quick shout out to that, whoever's doing your presentation.
Yeah, I will do that for sure. It's not me. We've got an individual, Tyler McGuire, that's responsible for that together with our CFO, Tom Kang. And they've really put the content together for us. So thanks very much. I'll pass that along for sure.
Makes sense. Yeah. Maybe to start at the beginning. Originally, you're from Estevan, Saskatchewan, a small town?
Mm-hmm. Yeah, born and raised Estevan, Saskatchewan. My father was from Norway. My mother, was from Sweden. We grew up. I had an older brother, since passed away, and a sister, and we were very active in the city with sports. Yeah, and my sister now lives in Regina. She's married to a retired judge, but my parents passed away about 22 years ago. But great upbringing, awesome upbringing. I don't think you could ask for anything more from a small town kid that grew up there and played all the sports. Lived the hockey dream as much as I possibly could, but and had some fun. Many good friends and a lot of fun along the way.
Pretty humble roots. I think your dad was a coal miner or worked in the coal industry.
Yeah, he was a carpenter that worked in the coal industry. You're right. And my mother was a nurse. And she was the ultimate caregiver for not just our family, but for the community. She was very, very focused on making sure that everyone got best medical care possible if she was around.
So the point is you had to work pretty hard too. You've come from a humble origins to be the CEO of Whitecap nowadays. So
yeah,
a lot of hard work.
Yeah, it's just what it was. I mean, my upbringing was everyone's going to have to work hard. And we all should do that. Work hard, be honest, be kind to your neighbors, and enjoy the moment as you're passing through. So, yeah, we were very humble beginnings, and when my parents passed away, we're very blessed to have the upbringing that we did have. All three children.
You're also pretty good at hockey. I think you got into the sport big time when you were younger and left about 1977 to go play in the States or something.
Yeah. So I had an interesting the Estevan Bruins, the big black and gold. I started playing with in junior hockey in the SJHL with the Estevan Bruins when I was just 15, not quite 16, and played there. Had a little bit of a stint with the New Westminster Bruins, and then I went to college in university in Minnesota, and I came back. And then I was provided the opportunity with a tryout for, first of all, the Vancouver Canucks, and then they traded my rights to the New York Islanders. So I gave that a shot. It was very competitive, obviously, and I didn't make it. I was sent down to the minors, and versus go back to the minors, I ended up back at because I lost my amateur status in the U.S. after I went to a pro contract. pro tryout. It was considered a professional contract, so I lost my amateur status in the U.S. to play college hockey, and I ended up at the University of Calgary. I met many long-term friends that I have today at the University of Calgary.
So is that a rough transition, those years when maybe you weren't going to make it? How did that go when you had to go back to Calgary?
Yeah, it was you were living the dream. I was, I wanted to, my objective here was to play in the National Hockey League. And you have to, my father-in-law, Red Hay, who passed away just last year at this time, I remember talking to him, and he said, as tough as it is, you got to get a new dream. So, just move on with your life. And, when I talked about, I had the opportunity to go play in Europe, and he said, if your dream was to play in the National Hockey League and you didn't make it, get a new dream. So off I went and started with Dome Petroleum in 1983.
Who's your favorite hockey player growing up?
Oh, that was, for sure Bobby Orr. The Boston Bruins was because we were black and gold in Estevan, and I think on Bobby Orr. And I really liked, some of the Islanders you had with Mike Bossy. As I grew older, I got to appreciate and respect, some of the players, Clark Gillies and a lot of the Islander players as well. But as a childhood dream, it was Bobby Orr.
So you would have been early 20s when you went to Calgary, UC?
Yeah, early 20s. I think I was 19, turning 20 when I got here and into Calgary, and then I finished my education and was fortunate enough to get working in the energy sector.
First job was at Dome Petroleum?
Yeah, Dome Petroleum, 1983. In the middle of what was the very unsuccessful National Energy Program. And at Dome Petroleum, I had the opportunity to work with so many very good people, whether they were strong technically, financially. Commercial negotiations is the team that I was in, led by Colin Ogilvie and Michael Grandin, and then from there I had a period of time for 5 years that you're kind of honing your skills and figuring out what the sector was all about, and then into the 1988 timeframe when Amoco took out Dome, and there was a clash, what I consider to be a clash of cultures. Dome being very entrepreneurial in spirit and objective, and Amoco was extremely structured throughout their entire organization. And although I was treated fairly and actually offered an opportunity to relocate in Houston in the marketing group, I was also recruited by Ketch Resources at the time in 1989. So not knowing what to do, I leaned on for the knowledge of an energy and business legend, Doc Seaman. And Doc Seaman, I intimidated, but I was able to get a coffee with Doc Seaman that set up through my father-in-law, Bill Hay, to get some career advice. And his recommendation was very simple, clear, and concise. Once I explained my dilemma, I loved Calgary. I was here. I was finished playing hockey. I was in the energy sector. Being offered an opportunity to move to the marketing group in Houston. And his comment to me was, I remember like it was yesterday. He said, Calgary is the energy epicenter of Canada. So why would you move to Houston? Stay in Canada and make things happen. So simple and refreshing. Led me to stay in Calgary, to move to Ketch Resources at that time, and was provided numerous career advancing opportunities over the years. Worked under different leaders and got to see different leadership styles in few individuals. Dick Gusella hired me, actually. Then came Grant Billing, and then back to Michael Grandin came back in as well. So I had a very fortunate to end up there, and then I can talk about where I went from there into Scepter and North Rock, and if you want me to go further on that. So
were you nervous that day you met Doc Seaman for coffee?
Oh, for sure I was. I mean, it was intimidating, and he was just so comfortable and humble. He's another from Rollo, Saskatchewan. He's a very simple, honest, I was in essence trembling when I was trying to tell him what I was, my dilemma, and he just was so vividly clear as to, what he thought about Calgary and what it would be, not just then, but well into the future. I was very blessed to have him, kind of endorse what I was thinking, but it just kind of endorsed and made me, start paving my way in Calgary, Alberta.
Maybe for the listener, who was Doc Seaman and why has he been important to the history of Calgary?
Yeah, it's interesting. Doc was he was a pioneer. He was a pioneer of Bow Valley and Bow Valley Resource Services, and he was the one. He and his brother, his two brothers, BJ and Don, they were instrumental with Bow Valley Energy Company and Bow Valley Resource Services building the first of the offshore drilling rigs around the world in Stavanger, Norway. So he was very entrepreneurial, just a small man with a big voice. When he said something, people listened, and was very instrumental in bringing the Calgary Flames to Calgary together with Harley Hotchkiss as well.
So was it around that time you started to realize you wanted to be an entrepreneur? Did you always want to be an entrepreneur?
Yeah, I always had an entrepreneurial edge to me. I'm, from when I was a young gunner, but I had to shelf the hockey dream when I was, and it's never easy for anyone to admit that you weren't good enough. But I made that admission and I drove forward, and I knew I had a work ethic to continue to get educated and learn from good people and be a good person, so from that point on, then I went to the rest of my career. I went through, and I can talk more about that because I think it's interesting to the pathways, the different pathways that people take. Mine was coming out of hockey and into the energy world, that knowing nothing about it actually when I started at Dome Petroleum.
Did you get a sense there was lots of opportunity in energy because you probably could have worked in other industries? What made you decide to work in the sector?
Yeah, it was interesting that you say that. I mean, the Calgary, as Doc Seaman alluded to, was the energy epicenter. So there was other, would have been other opportunities, but we had the bigger companies here at that time. Shell, Amoco, the Amoco that it took out Dome. You had Texaco here, so just generally the people that I was associated with were in the energy sector. So why wouldn't you? Work in the sector and get to know all the people. And it was such a thriving, if I can use that, business community. People were willing to help out and jump in. And I thought, geez, man, this is where, I want to live and I want to make a home for myself, my wife, and my family.
So the 80s, you thought to yourself, the NHL was not in the cards, but this is a great sector and I can make my career here, more or less?
Yeah, totally. I mean, we were, being from Estevan, it was yes, there was oil and gas there, but it was a coal town. Some of my summer employments were in the coal plant down up with Luscar. But this was the big leagues in Canada. If you wanted to be in energy, you were going to be in Calgary, Alberta. So, and what I mean by the big leagues is this is where all of the major operating companies, this is where they were based out of. They weren't based out of Edmonton or Toronto or Ottawa. They were based out of Calgary, Alberta.
So your first day at Dome, what was that like? Were you nervous? Or?
Yeah. Well, I knew some of the people that were there. For sure, you're nervous. I had gotten to know, just from some of my vintage of people that were in the neighborhood that we were living. I got to know them, but yeah, for certain you're nervous, and then you just look to carve your path and learn from those that are far more experienced and far more intelligent than I was to learn from. So, yeah. But it did lead. It was a great starter kit for me, and then Amoco, and then the Scepter through to North Rock, and then started my own companies. But I can talk about that if you're interested.
Yeah. So maybe fast forward through the 80s and 90s, and I think you got your first company going, which was Ketch Energy.
Yeah.
You've had a bunch of companies through the years. So maybe to start with Ketch Energy.
Yeah. You know what? I'll back up a little bit if I can, just for a moment, back up just behind that. When I left Amoco, as I said, I had the opportunity to go to Scepter Resources in 1996. And I was there and provided lots of opportunities with the three leaders, Dick Casella, as I said, Grant Billing, and then Michael Grandin. And I had lots of opportunities in different areas, generally around the business development side that I enjoyed. Scepter received an unsolicited bid. And rather than waiting on closing, I moved over to join another Dome alumni, Don Hansen at North Rock Resources. And again, put me in a leadership role to advance there. And after 4 years at North Rock in year 2000, at the coaxing of a good friend that I consider to be a dear friend of mine, Brett Wilson, that was running First Energy at the time, led me to launch into my first CEO role at Ketch Energy, alongside a couple of what I call awesome wingers, Paul Sharon and Dave Momberket, that still works with us today. At Ketch Energy, we experienced exceptional growth. That started in 2000, both organic and through acquisition initiatives, and end up monetizing the company into two separate entities in 2002 at the height of the royalty trust era. An income trust named Acclaim Energy Trust that Paul Sharon went to run, and spun out Ketch Resources that I took a small component of our team and as a growth company, and we renamed that from Ketch Energy to Ketch Resources. That was the second company. So Ketch Resources, it was explosive growth. I mean, because we had some undeveloped lands, we had ideas, and we ran that company from 2002 to 2005. And once again, we used the royalty trust era. We merged with another junior by the name of Bear Creek Energy and formed the Ketch Resources Trust, again spinning out some undeveloped acreage and a small amount of production to form Kereco Energy. Really, we took our trading symbol, KER, and added ECO as a growth company. And once again, I stayed on to run with other key personnel that we took out of the combined entity. And from Kereco Energy, then we went from 2005 to 2008. And there was a tumultuous time in there. Commodities were moving all over the place. We ended up monetizing some of our assets and changing our name to a company called Cadence Energy in early 2008. And shortly after changing the name to Cadence Energy, we received an unsolicited bid for the company in the middle of Stampede Week from Barrick Gold out of Toronto. And we subsequently sold to them. And that concluded the Ketch, Kereco, and Cadence trail of companies. Fortunately enough for our employees and our shareholders, that the closing of the sale took place just 1 week prior to the Lehman debt crisis in 2008, leaving our employees with cash, our shareholders with cash, all feeling pretty good. And as I've said many times before to our staff, I'd rather be lucky than good, and this was a time that it was very appropriate to be lucky.
Originally, the North Rock financing, Brett Wilson and I think Jim Davidson did your first financing on that company. Do you remember those days? And was it hard to get that across the line? How did that go?
Yeah, no, I mean, Don was Don Hansen. He was what I considered at the time one of the smartest engineers that I worked around or with, and we were able to finance appropriately. It wasn't as difficult then to raise capital, and Don was kind of the master of communication, and therefore. But working very closely together with Jim Davidson and Brett Wilson and the entire team. They had a very, very resourceful and entrepreneurial team. It was, enjoyable to work with them.
Did you get a sense that the reason you went with First Energy was because of that entrepreneurial spirit? And because you probably had options for investment banks, but
yeah, at the time, there was, because Brett had convinced me. I had no illusions of ever being a CEO, but Brett convinced me, you can do this. And there was no conditions with it that we had to do the financing through them or anything like that. But when someone believes in you that much, that's where we started off with them. And then we spent some time with the new Crest, and then we into GMP and the different financing entities. But definitely was the starter kick for us was in 2009 when we started the company that we have at this particular time. So Whitecap Resources.
And then you got Ketch Energy going, which was your first one. Was it a big risk to get the company going?
Well, it was. And it was in terms of you had to put money at risk. I remember telling my wife after the fact that I'd remortgaged the house. We had a mortgage, but I increased the mortgage. I didn't tell her in advance, which was probably a mistake. I wouldn't advise people to do that again. But you had to put skin in the game. And I did that. Fortunately, it worked out for us. But I wouldn't advise people to remortgage their house. But we did. Things worked out very well for us as we advanced along. So,
did you have a plan B if Ketch didn't work?
No, there was no plan B. There was always it goes back to determination, and you just got to make this work. So long days, long hours, but with good people. And if you surround yourself with like-minded people, I think you can accomplish a lot.
And so what was the business plan? Did you have to drill straight up, or did you buy production? Was it stressful?
You know what? It was what we did was we went into a company called what were they? Interaction Resources, and we changed the name. So it did have some production, Wildman production. It had some oil production, and so we had enough cash flow to start a drilling program and get that moving. So that was a starter kit, for at that particular time.
So you weren't totally betting it all on their first well.
No, no, yeah, we did have some cash flow, but every well mattered. That's our business, and that's the energy business. Every well still does matter, but back then, it mattered more.
And it's hard to imagine now, but was it hard to get analyst coverage and people to support you at the time?
No, it is. We were new on the block. I mean, I was known just because I was worked with Don Hansen at North Rock Resources, and that was kind of a darling of the energy side of the junior sector at that particular time. So just because it was such a darling, people knew. I got to know them, and I was quite social at the time, so I got to know people. I am still quite social, but I was more social back then.
It wasn't a terrible challenge. You had some support.
That's right. Yeah, you did. I mean, and this is what it gets back to, and I advise all these young people today, just be honest, work hard. Even if you're not the smartest bulb in the pack or the brightest bulb in the pack, make sure you work as hard or harder than everybody in the pack. And I use that to my advantage, making sure I got to know as many people, but I was never afraid of work ethic.
And so maybe fast forward a bit through the companies, which we kind of touched on, to 2009, which was the start of Whitecap Resources, your current company. Was the beginning. So
this one's an interesting one because here we are 16 years later. And in September of 2009, and we had gone through the debt crisis, the Lehman debt crisis in 2008, 2009. We took a small group of individuals, again, Dave Momberquette, along with me on the business development side, but looking for assets. And we were able to land an asset. And what I considered to be a very small group of individuals, there was 5 or 6 of us, I think, holed up in a small office. And we were able to land the Valhalla asset in September of 2009 with 850 barrels a day of production in the Valhalla field in northwest Alberta. So that was a starter kit. And 16 years ago, the Valhalla development underway, we started our journey with 2 smaller corporate acquisitions in 2010, Onyx Petroleum and Spitfire Energy, becoming publicly traded through a reverse takeover of Spitfire in June of 2010. And that was really the start of our publicly traded history. I can go through, and then we could talk about the acquisitions. Yeah.
$46 million market cap with about 850 barrels of oil a day at the time, I think.
That's what it was, yeah.
Relatively small.
Really small. And raising money. I mean, raising money at that time, you think of coming out of the debt crisis, I can recall. And at that time, it's not as though people were falling over themselves to support the energy sector from a financing perspective. But I remember thinking AEC, who we bought the asset from, gave us 30 days to finance. So I called on some favors of friends, Wayne Deans and Dean's Night in Vancouver. I called on Rohit Segal, that was working in Toronto. The Pat Nesbitt with Great West Life in Winnipeg. And, our objective was to raise, anywhere between $30 to $40 million. Well, I started off in Vancouver with Wayne Deans, and then we made our way. I made my way back through into Winnipeg and off to Toronto. And when I got to Toronto, um, Wayne Deans had called me, Pat Nesbitt had called me, and Rohit Segal said, "You're done." So I flew back later that day. We were financed. I mean,
Mm.
much. It sounds like it was easy. It was not easy. But anyway, we were able to get funded. That was the starter kit of Whitecap Resources. So that was a $40-60 million market cap. And of that capital, the small team we put in just over $12 million ourselves. So that was the starter kit ourselves for what it is today.
I guess you had a bit of a track record by the time you got Whitecap going. So it wasn't, although it was the financial crisis, it could have been worse, I guess.
Yeah, that's right. I mean, I had the history with, running the companies with, Ketch Energy, then Ketch Resources, and then Kereco Energy. So you did have you had a path that you had established for yourself, but the timing, coming out of the debt crisis was quite an interesting time.
Did you get a sense there was opportunity during the crisis, even though it wasn't energy related, but it still presented to?
Yeah, absolutely, Trevor. I think that, when I was thinking about it, the world goes around on energy. And that's what it is. So, and I've not changed to this day. I've not changed my mind on that. And so, and back in those timeframes in the mid 2000s, we were still more in the exploratory phase, not in the development phase as we are today. But there was resources to be found, and if you had the right technical people alongside you, and our two technical leaders on the geotechnical side were Scott Oldale and Daryl Metcalf, that we brought into the team, and they were finders. They were finders, and so if we could do that and advance forward, we were going to do well, which we did with as I say, the companies. So that was in the Ketch group of companies. And then, Whitecap, you just always have to make sure that I call them the Whitecap All-Stars. You're always making sure you have the best technical people in your organization to advance forward from.
In 2009, was it relatively easy to purchase underpriced assets at the time? Did you view it that way? And was it a big chance for you?
I thought so. We believed that it was a good time to get started, and but you had to understand, if you're going to buy assets, what you're going to do with them. You weren't just buying them to blow them down. There had to be some growth potential off them. Mm-hmm. So we thought there was, and it was, and it's obviously worked out quite well. So to the stage where we're at this particular time, at 370,000 BOE per day of production.
You could see the opportunity at the end of the financial crisis, or even during it. It was a good time to start a company.
Yeah, we were hunting around. You had to think that was not going to be forever in the financial crisis, that we were going to climb out of it, but it was going to be, there would be opportunities. So if you could position yourself appropriately, you could take advantage of that and have good success. So, but it had to be, I say it all the time, even with the size of the company we are today, these assets don't run themselves. It's all about people, finding and developing and extracting the resource at the cheapest price possible. So that's what it's all about.
And what was the original business plan for the assets at the time for Whitecap? What were you thinking?
Well, we thought, that oil would come back, but also we thought that there was a better chance that gas into the future was going to be the product of choice. We're still saying that today, but here we are 16 years later. But I do believe that gas becomes a commodity of choice. Light oil or oil is going to be around for decades to come, and we believe that. But we just think there was going to be an opportunity. Thought that there was going to be an opportunity for natural gas products to be developed as well.
And so the model for the junior E&P sector in Canada has kind of shifted through the years. It used to be maybe not easier, but it was more common to flip the company or sell it at the time. Did you recognize that? And did you think to yourself, we need to build this up and flip it? Or were you thinking this will be a long-term company? How were you thinking of it?
Well, I certainly have. We talk about that with our management team that have been with us for 16 years since we started this. In the we had looked at maybe, I remember us getting together, our big planning meeting we had. We didn't really travel much, to go away to talk about a strategy. We had a strategy session just over at the West End in a room that we rented for a day and sat around to say we could monetize this in 2012, or we could convert it to a dividend growth strategy. We were just a growth company prior to that, and we talked about it. We spent the 3/4 of a day just talking about the options that are available to us because we had an approach from outside to maybe monetize. And I said, you know what? My preference is, if you guys want to go this direction, is let's start paying a dividend, slide back our growth rate a little bit, pay a dividend back to our shareholders, and continue as a growth company that pays a dividend. So that's what we did in 2012, start paying our dividend.
So the idea is that we could build a sustainable company here,
Totally.
have a healthy payout. And what was your rule of thumb on the payout at the time?
Well, 20%. We like to have, I'd like to have a dividend at 20% of your cash flow. Depends what you needed. We talk about the three pillars of sustainability, I call it, is number one, your decline rate. Number two, your cash flow net back, how much cash you're getting out of the resources you're developing. And then your capital efficiencies, how much capital it takes to develop more resources to bring them. So if you put in all that mix, somewhere in the neighborhood of maybe between 18 to 22 or 24% of your cash flow can go back to your shareholders. When you're giving it back to your shareholders in the form of a dividend, obviously you're going to reduce your growth rate because you're not putting that capital back in the ground. But I think that works into an overall basis, and that's how we've been running the company, not only when we started it, but back to the Ketch group of companies we were running the same way.
In hindsight, have you found that even institutional shareholders, of course, retail appreciate the dividend, but they like the dividend in an energy business where it's so volatile? Do you think that when you look back on things, that was the right decision?
I think so. I think there is, you look at the number of producers today, you just have to, that have a dividend.
They all do.
Yeah. And why that was important is to give your shareholders something on the way through. Because knowing that we are in a volatile commodity price environment, over the long term, if you can, kind of pitch your business at a low pricing where you can, in essence, guarantee that you're at least going to get a dividend, your share price is going to alter as you advance through time with the commodity cycles. But at a minimum, you're going to get a good dividend as you walk through. I think that resonates with the right shareholder.
And so the comment has been that the trust sector disappeared in 2005, I think, but the sector's evolved into almost the same business model where companies are giving back the capital to shareholders now.
Right.
Did you see it that way too? And that
not at the time, you didn't. But the one of the challenges that we've had is because of the policies that we've had in our country, the federal policies over the last 10 years. You're not rewarded for growth. You're not, from an overall perspective, it's been a challenge. So what you do have for shareholders at a minimum is a constant and a consistent dividend that you can give back to them as you're growing your business. And hopefully on the other side of this thing, on the other side of the challenge that we've dealt with for the last 11-year period of time, you can actually get back to where we can develop our resources at a much better pace and provide that for the benefit of all Canadians.
And so you're also good at doing deals. Through the years, you've put together a bunch of deals at Whitecap. You got Husky's Southeast Saskatchewan assets, 2016. You took out the Weyburn unit from Cenovus in 2017. How did you get good at doing deals?
Well, that's funny. I mean, I've always been enjoyed the thrill of the hunt, if I can use that. and to this point in Whitecaps, I don't know if I'm good at it or our team's good at it. I think that I'm just one component in the team that can get transactions over the line if we really like them. But to this point in time in Whitecaps history, we've completed 19 corporate acquisitions, 22 asset acquisitions of size, and the most active time for us was post the 2020 COVID environment. You talk about that. The COVID environment, such a disruptive time for everyone's lives. And once we gained comfort that life would return to normal or relative normal, and the energy was once again going to be once again going to be a key component of people's lives, we went aggressively on our front foot, building a stronger, more resilient company. And to talk about that, we acquired 6 corporations from early 2021 and culminating with the purchase of XTO in 2022. We again stepped forward earlier this year in 2025, concluding with the Baron business combination in May. And with a very strong operational execution from our expanding team, we're in a very enviable position with approximately 370 to 375,000 BOE per day of production, as I had talked about earlier, and a very long-dated inventory of growth opportunities. 11,000 wells in inventory, and we're drilling about 300 wells a year. So we're very long-dated inventory of opportunities. So, if I can comment, this just doesn't happen. It is a lot of work, but it's not just a lot of work for myself. It's our full team. And I need to comment for sure. It's the efforts and the time commitment from many members of our team, if not all of them. But it's been monumental. If we look back in history, we can be thankful that we have supportive or perhaps said patient spouses and families that have allowed us to do what we've done. And I count myself very lucky to be the one that had the privilege to work alongside our management team, our staff, and our board of directors, building Whitecap to what it is today. We would not have been able to do this as individuals. We have been able to do this as a collaborative team.
One of the ones you did was Torque in 2021, kind of at the peak of energy and real tough time for the sector. So how did you think about that? How were you able to push through, and did you see a value? And
yeah, we did. It was interesting because of the coming out of the 2020 COVID environment. All energy companies were trying to figure out what they were going to look like, what they were going to be, and it was an interesting conversation, and it was initiated. I guess I maybe initiated the conversation, but Brett Herman, who was running Torque at the time, he understood what we were trying to do, and it was going to mean that we were going to be a larger company. We were geographically in a little bit different areas, and maybe if we put the two together, it'd be for the benefit of both sets of shareholders. So he was the one that I was able to convince, or we were able to talk to, saying this is going to be for your benefit, as he was a sizable shareholder in his team, and we still have members that came from the Torque team with us. He had some very good technical people as well. But yeah, it was identifying what we were going to look like coming out of this COVID environment, and he agreed that this was something we should do, put the two companies together, and we would go ahead and run it, and he would figure out what he was going to do in his next life.
Was that a bit of back and forth between the two companies? From your perspective, it's a great time to buy, but to sell, I guess your argument was that there was upside continuing with Whitecap. But was that a tough sell?
No, I don't think so. I mean, certainly, nothing comes easy. I mean, I wouldn't say it would be easy, but both sets of shareholders were going to end up with shares. Whitecap shareholders and Torque shareholders were going to end up with the combined entity shares into the future. So if we could position a property with the right level of leverage, and that's what you're kind of doing lots of modeling during that period of time. But yeah, it was, I think that he understood, that we were going to be able to advance forward.
We've also done some deals that kind of led into tough times. I remember when you bought Beaumont in the spring of 2015, right as the market fell out. And then when you did Varen, it wasn't initially rewarded in the market either. How do you think about that? How do you push through? And do you just see the value at the end of the day? And
Yeah, both of those. It was interesting because your timing can never be perfect on any transaction you do, but you have to have a vision as to what it can be over a 3 and 5 year period of time. Whether it was on Beaumont, but more certainly with the Varen transaction, we think one of the most enviable inventory sets in the sector at this particular time, with lots of optionality, both on crude oil, light crude oil, as well as natural gas, as well as liquids-rich natural gas. So you just have to have a vision and continue to push through, and not get over your skis where bring on too much leverage, because a lot of the entities in our sector, they take on too much leverage, and then you're really stymied, and it really puts your company, in essence, in play or out of business, or both.
Hmm.
So,
and you've also bought companies from people who you could say knew what they were doing, so to speak, like the Beaumont crew are very good operators. So how did you avoid not overpaying from a team like that when they know a lot of what's under the ground?
you have to have it goes back to our people that I mentioned earlier. It goes back to the people that we have in the organization. You have to believe in it, that we can extract more than what they were doing, at a lower price, with a higher net back, for the benefit of our shareholders. And you have to have that commitment, I think, with your people. And if you're second guessing your people, you probably shouldn't enter into any of these type transactions, whether it's just purely an asset acquisition or a corporate acquisition. You have to have the confidence in your people to lead, and through what will be over time. There's going to be difficult times and there's going to be very good times, but stay evenly keeled and evenly balanced, and have an end goal as to where you want to get to ultimately.
And you had the long-term vision to keep and also enhance the properties, which was where the value comes from at the end of the day.
Totally. That's exactly right. And being able to say, what are some of the things that we can do perhaps a little bit differently on each one of these assets to extract value, for shareholders.
You've gone through M&A, but you've also grown organically through the years. So how do you think about the balance between organic growth and M&A? Do you think we got to drill? I mean, we got to get going through the drill bit too. How do you think about that?
Yeah, I think it's a balance. I do believe that your assets, you have to take what they'll give them, what they'll give to you. So the assets, from our perspective, I think that all your acquisitions are really trying to set up, future growth opportunities organically. So that's the way you think about it. If are you in need of buying something, if it's just to blow down? No, we wouldn't be doing that. Maybe some entities do that and can effectively change their operating cost structure or something like that. But we always look at it. Can we, um, with the inventory set that's in front of it, or are we better to just drill? Are we better to get a better return for our shareholders by just drilling out what we do have versus looking to acquire, more assets? So it's I think it's a blend. I think you need a combination of both. I do think you need organic growth in your organization. I do believe you need acquisitions, as well as, we don't really mention that much, but just dispositions as well. We look at assets that we're not going to put capital to work on, and if someone approaches us, with an effective price that would be above what we're going to extract over time, we're okay with monetizing that too. But it can't be at giveaway prices either.
And as a result of being around for a while, did you view properties with in-place resources that time and technology would be your friend? And through the years, it's hard to pinpoint in a presentation, but eventually they would be your friend. And as a result, you'd get more oil through the years. Did you think about it that way?
Yeah, you do. You do think about, you don't, technology is going to, you look at where technology's come from and where it is at this particular time. We're not done. I think,
Yeah,
if I
exactly.
think about it in the baseball analogy, you know, maybe we were thinking, back in coming into the COVID environment, that we were in the seventh or eighth inning. Now I think we're back to the third, maybe the second or third inning.
Really?
It's with technology. Technology is advancing so rapidly, whether it's on the length of your horizontal drilling locations, your open hole multilaterals, your frac technology is changing at rapid speed. What we're using the products for. for a data center usage. Technologies are advancing, and they will continue to advance. It. I don't know if they'll continue at the rapid pace that they've been going at this particular time, but you have to think that, and this is the admiration that I have for these young, educated university students coming out of school here, that in the last 10 years, they are light years ahead of where we were, my vintage of individuals. So I just admire, and, just keep feeding them, because they'll keep coming forward with new and better ideas to advance technologies.
And for the listener, the recovery rates used to be, I think, single digits, but now they're at least in some cases double digits. So what would be an example of that, and how do you present that to investors?
Yeah, it's a perfect example of that is, you're right. If we could get focus on getting somewhere between a 6 to 8% recovery rate on our resources now, through whether it's through enhanced oil recovery initiatives, whether it's water floods, polymer floods, or CO2 floods, you're getting upwards of 40 to 50% recovery factors. In oil reservoirs, natural gas is a little bit different, but I think that just because it flows easier, that the flow pattern of natural gas is easier. But anyway, you're getting that. That's a big change. When you're taking maybe 8% recovery factor into the, 20%, but maybe you can take it further into the 30 and 40% recovery factors. And that's why I say that we're not in the seventh or eighth inning here of our energy sector. We're in the second, third, or fourth inning, maybe second or third.
And again, for the investor, when you increase the recovery factor, you can also increase your reserves at the end of the day, I think.
That's correct. Yeah. Recoverable reserves. Yeah.
Got a lot more inventory.
That's right. That's right.
So that's good.
It's awesome. It is. The energy sector. When I reference the energy sector, I'm more specifically focused on what we do in the oil and natural gas sector. It's exciting because you have these new technologies that are advancing. It seems like monthly, if not weekly. Coming forward with different ideas as to how to extract, and people are using more and more energy all the time. Whether it's their handheld devices or the way they transport, the way they heat their homes. It's a marvelous time to be in energy.
And so, speaking of oil recovery and operations and the company, the current drilling program for Whitecap, where are the rigs running nowadays, and why?
Yeah, so we're busy right now. Our operations, we're running 17 rigs. We have two divisions. One we call the unconventional division, which is our Montney and Duvernay assets, and they're running 7 rigs as we speak. And the conventional division, which is primarily light oil and liquids, a little bit of liquids-rich natural gas in central Alberta, but they're positioned in Saskatchewan and into central Alberta, and the unconventional is really up in northwest Alberta. But the conventional division running 10 rigs at this particular time, and all of these wells are being drilled horizontally. So, it's a busy time for us for sure.
A bunch of the capital is, as a result of the Variant acquisition, being directed towards the unconventional resources, Montney and Duvernay. Well, maybe we'll get into it a bit more, but why have you felt that area deserves money, and what value are you seeing there?
Yeah, the unconventional Montney and Duvernay assets, just as an example, next year, you're right, in terms of we're spending $1.5 billion of our $2 billion budget, $2.1 billion budget next year in 2026. There's plenty of growth potential off those assets. So the Montney and Duvernay, we're going to grow those assets next year somewhere between 8 to 12%. Just organically through the drill bit. And when we look at that relative to our conventional assets, we're going to about 1% growth, but what we call our conventional assets, slower decline, 19 to 20% decline, stable, very stable production base, but generates a very significant amount of cash flow because of the light oil nature of the business. And just to put this in those terms, next year, with the production that we'll have out of our unconventional division, spend $500 million, cash flow $1.4 billion at $60 WTI oil. That will pay for not only them to hold their production flat or grow it just modestly, but it also pays for a full dividend. Where the unconventional division can actually grow within its cash flow. And as it continues to grow, it will ultimately be a funding resource for itself to pay its own dividend as well into the future. But today, the stabilizing assets pay our dividend, stay flat, relatively flat, and let the Montney and Duvernay grow as we're advancing forward.
Do you remember when you realized you thought we should have a look at the Montney/Duvernay and that I maybe need to get involved with these assets?
Well, this is interesting. I mean, people don't realize this. Our starter kit, when I referenced Valhalla earlier, that's a Montney play, but it's a conventional Montney turbidite. So we had, when you get into this unconventional play, where we started getting more active in that was one of the corporate acquisitions we did for 8,000 barrels a day in 2021, Timberrock. That led us into ultimately led us into, or was it Timberrock? No, that was, I think it was Kicking Horse. Yeah, it was Kicking Horse, not Timberrock.
Okay.
There were so many just acquisition we did there, but Kicking Horse, that led us into the XTO transaction because Kicking Horse had a joint venture that they had with XTO. Well, people didn't realize that when XTO put themselves up for sale, we had bought Kicking Horse, so we had access to all the information. That was a massive advantage for us at that time. Every transaction has its own little quirks and crannies.
So you thought to yourself, this looks excellent and we should keep our eyes on this.
Totally.
Which increased with the Varen acquisition a couple years ago.
This year. We closed May 12th this year.
So you were aware of the possibility in the assets.
Yeah.
And maybe again for the listener, how much opportunity is there in the Montney/Duvernay without giving precise numbers or proprietary information? Do you see a lot of upside there?
Yeah, it is. It will be massive. I mean, we will see more out of the Montney. The Duvernay is a little bit further along than the Montney, but once we get infrastructure, and this is where the federal government can play a part. Once we get more infrastructure built to get our products out of the basin, maybe fourfold where we're at today, maybe fivefold where we're at today, the Montney and Duvernay assets, it is explosive, and what it could do for the benefits of all Canadians is massive. This is where we just have to clear the tracks and let this resource be developed.
The big value prop at times is the liquids production from those wells. The gas production is also excellent, which has been bittersweet because the basin's been flooded with gas. How do you think about that? Does it worry you with too much gas? Do you, as the number 5 natural gas producer in
what not worries about, or we have to think about pacing, because that pacing goes into, what price we're going to sell that product at. I mean, the gas that we're developing today, we're not developing our dry gas, but we're developing our resources that have liquids associated with it, because of the pricing. So from a natural gas perspective, the liquids still pay the freight. But once we get more takeaway capacity, this is where LNG Canada 1, the expansion to LNG Canada, we have Cedar Creek coming, we have the wood fiber, and we're part of the Kailisms project. But I think that once we get more takeaway, and we're putting more takeaway capacity in the United States of America too, we can't forget that the largest economy in the world is the United States of America. Why we're even remotely thinking elbows up or whatever we're doing there, that's a mistake. What we should be doing is how do we cozy up to get tighter with the United States of America? Not saying that we're going to go to do battle with them.
Right. So, yeah, Whitecap has exposure to marketing agreements in the States. I think you've got a lot of, you're not just relying on eco prices either. So it really, really helps the company. Maybe good for the investor. What exposure do you have to those markets to help dampen the weakness?
Yeah. I mean, right now we have a big push to get more actively involved in it, where we're living this live into the U.S. Mid-Continent. We think that's going to be a very strong basin for the longer term for natural gas to get more NYMEX exposure versus AECO exposure, with the basis differential that drifts all over the place. Longer term, I think AECO is going to be an okay place to be. Okay place to live. But in the near term, for the next, what we'll call 3 to 5 year period of time, the preferred pricing centers are going to be in the U.S. Mid-Continent or into California, or into LNG. So we'll see if LNG gets built out at the pace that we think it should get built out at.
Infrastructure is also a great way to, I guess, make yourself robust to low pricing. How does Whitecap think about owning the gas gathering systems, and I don't think it's as important for oil, but how do you approach that subject?
You know what we've done a little bit differently than some other companies. So we have a very good relationship that we've have with Pembina PGI, and they've been very, very good to work with. So we work with them to, in actual fact, at our Latour area in the Montney, we're building a new facility. Their money, we're building it
Mm.
with their money. It's very unique, and so we can. At the end of the day, we'll have that project on late 26. We were previously talking about early 27, but it'll be late 26 now, up to 30 to 40,000 BOE per day, and we'll have that project done. We're building it. They're paying for it. They'll get the fees that we'll pay over time. So our strategy has been a little bit different than some other companies, but it works for us. It works for Whitecap, and we're excited about that.
So you're participating in a new facility build out.
Brand new build out.
Interesting, which lowers, or I guess gives you security on your marketing and your transportation of your products. Is
Correct.
The point?
That's what you want. Yeah. There's always that, if we own it, we operate it, or we have ownership in it. It's interesting. We transfer ownership when it's built, but to BGI, but we still have first call on all throughput through that facility into the downstream of the products.
The other side of your assets is the conventional assets, which there has been enhanced recovery from other companies operating like Tamarack with the water flood. Are you watching that? And what are your thoughts on the water flood? Are you implementing it? And how's that going for you?
Yeah, well, 50% of our production in the conventional business is under some form of EOR, whether it's water floods, polymer floods, or CO2 flood. So we continue to look at advancing. We've got a very highly technical team on water floods that work on not just water floods, but on polymer and CO2 floods. We got a reservoir development team. So we'll continue to look at all assets that we can add, repressurize the reservoir or help force the products along with either water, polymer, or CO2.
It's not a new technology, but why is it working so well nowadays for certain companies?
I think it just, if you look at, we're not in the Clearwater play, but I understand that it has been working there. We're not in that place, so I can't comment specifically. But the Clearwater play was nowhere 2.5 years ago. This is all new. This is 2.5, 3 years ago. It's new.
And even today, literally.
Yeah, no. So that's why I say that it's, so when I get back to that comment that I made earlier, we're nowhere near the end of life of energy resources. We're nowhere near it.
Right.
We keep finding more different ways to extract the product to advance forward from.
You're also a leader in carbon capture storage, the project you have going. But maybe for the listener, what is that project and why do you see value in it for investors?
Yeah. When we acquired that in 2017 that you referenced earlier, we were producing net to ourselves about 15,000 barrels a day. Here we are today producing about 15,000 BOE per day net to us. When you're putting CO2, first of all, you start with water floods, but then when you put CO2 in the ground, it actually fills the pore space that allows us to extract more. So our decline rate remains on that particular asset somewhere between 3 to 4% on that. So we have these rollouts that we put more CO2 in, that we continue to roll out into different areas. And we have if we would have had the right environment with the previous federal government, we would have been doing more CO2 floods. But what they wanted to do is take this the CO2 and not allow it to go into partially depleted oil and gas reservoirs because it extended the life of the reservoirs. So that's kind of upside down way of thinking. Wouldn't you want that more? But they were forced to say the only credits you could get is if you put your CO2 into saline aquifer storage. But we're looking potentially, we're not there yet, but maybe this government under the new leader, we can convince him that this is the right thing to do, because there's lots of partially depleted reservoirs that could take on CO2.
So for investors, you got involved with the project partially to help with carbon concerns, but it's also good for enhanced oil recovery too.
Right. Yeah, no, it's that's why I say it. It is really it flattens the curve on your, when we're always looking at, as I mentioned, one of the key criteria is a low decline rate. Well, that's a very low decline rate that we have to work over.
So you're making money on it.
Oh yeah, I'm making money on it. I think it's paid off. Since we bought it, I think it's paid off for sure 2 times, but maybe 3 times over.
Which is good for business. Well, that's a lot of operations questions. Maybe some financial questions, if that's okay.
Yeah,
Right
for
now,
sure. Yeah,
you're
that's fine.
kind of balancing growing production with giving capital back to shareholders. But how do you think about that in terms of the buyback, dividends, growing production? What's your plans for that?
Yeah, we've been, Trevor, we've been fairly what we'll call countercyclical. When in this pricing environment, when um, this commodity price environment, equity prices generally are lower. So they don't. We always think about it relative to our intrinsic value. Should we be buying back shares? This is a time frame where we have been buying back shares because our intrinsic value is quite a bit higher. We'll have our year-end report out, but quite a bit higher than um, than where we're trading at today. So this is a time to reduce your dividend obligation by buying back your shares. And there'll be a time frame where when commodities come back, I think that oil trades somewhere now. We're right around the $60 oil. It'll probably be 70 to 75 sometime later next year or into 27. But that's a time frame for us. And when I talked about the countercyclicality of the way we run, is that's a good time for us to strengthen our balance sheet, really put as much on the balance sheet as we can to prepare for future opportunities. So generally what our sector has done, when commodity prices get higher, they pay a higher dividend. Well, that wouldn't be that. We're a little bit reverse to that. When commodity prices are higher, sure, you can start, if you could grow your dividend commensurate with your growth rate and your company, but not, you know, put, so much into your dividend. And this is where there's a base level of dividend and there's special dividends. We only pay a base level of dividend, and we'll walk that up, not in the near term here, but we'll walk that up over time. It goes back to your overall belief that you've got to grow your business. From our perspective, we talk about growing our business organically on a production per share basis, 3 to 5% per year. You put the dividend on, and our yield we think is too high at this particular time at 7%. So between 3 to 5%, you're already at a total return to shareholders between 7% and 3 to 5, which is 10 to 12%. And then if you buy back shares, maybe 3 to 4% of your shares every year, you get into this range of 10 to 15% total returns to shareholders on an annual basis. And that's the way we think about our business going forward. And we've been doing this now, and that was, for quite a period of time. Commodity prices are what allowed us to do the Varen transaction. Is our debt was under $900 million at the time. Their debt was $2.5 billion. Put the two together, and our debt to cash flow is still at or slightly under 1 times debt to cash flow.
Right.
So that, that's where using your balance sheet effectively, and I'll have to tell you, our CFO, Tom Kang, is, I think he's a master at it. He's really, we don't always agree, I can tell you that, but because sometimes I prefer to grow a little bit more aggressively, but he's a very good counterbalance to us in the organization.
And yeah, so speaking of debt, I think your target's about 1 times, I guess however you want to frame it, cash flow is the idea. But for investors, why are you targeting that metric?
Well, just to, we like to be at or under 1 times, too much leverage, then you're putting too much into your call. We are, we feel strongly that you use debt effectively. Our cost of debt, our most recent financing that we did, because we're investment grade, was at 3.76%. So after-tax cost of debt is 3%. But we've been able to get there with our size and the way we manage our business. And we've got capacity of $1.6 billion. That doesn't mean we should go use it. But into the future, we may use a portion of that into the future as we look for other acquisition opportunities, as long as they strengthen our organization to go forward from.
3%, even in this environment, if you look at it historically, is very low.
Totally.
Especially if you compare it to the 80s. As you know, the interest rates were much higher.
Totally. Yeah.
But you don't need to use it.
you don't need to use it at this time. We've got the spare capacity of $1.6 billion, but we're not jumping out to just go and use it at this particular time.
And the dividend, very important. But without giving me your secrets, do you view potential increases in the future? How do you think about that?
Yeah, I definitely want to have increases into the future, but not today. We like to keep that somewhere. We're about 24% of our cash flow being paid out, 24 to even maybe 25% with commodity prices where they're at today. But we prefer to be that around into a dividend, about 20 to 22%. So we'll want to grow a bit more, have a little different commodity price environment before we get back on the track to grow our dividend into the future. But we are a dividend growth company. We will grow into the future, but in the right pricing environment with the right amount of product behind us.
At $60 oil, I think you've characterized the Whitecap budget as defensive for 2016. It's about $2 billion to maintain productions and everything else. But how do you balance disciplined growth in this environment? And what happens if prices start to go up? How do you react to that environment?
2026, you mentioned 2016, but our budget for 2020.
Yes.
Anyway, that's okay. So this is where, again, a minimum growth that we're looking in our organization at 3% minimum, using the $60 oil price environment. You dovetail that. A lot of people don't realize, and one of the other complexities in our business that people don't follow the business directly is we have a weak Canadian dollar. And that's one of the benefits historically of having a weak Canadian government, actually. But is
100%.
We're dealing with a sub 72 cent Canadian dollar. So when you put that on $60 oil, you're dealing with prices between $80 to $85 WTI. Realized price that we get in Canada for our products. So from our perspective, we want to grow organically. At a minimal pace. We are a growth-based company, so we'll grow, and we can grow more aggressively, a little bit more aggressively in a higher pricing environment, and then we can also dovetail in potential acquisition opportunities or more share buybacks in a higher price environment. We can do that as well.
So at the margin, you can, there's some flexibility in the budget.
Totally. You know what? I think one of our VPs of one of our areas of the unconventional area or the conventional area talks about, being capital intensive ready. So always our assets are ready. If we want to pull a trigger for adding more capital into we have to be, drill ready, capital intensive ready for the future. That won't happen in the first half of 2026, but might if we do see a different commodity price environment in the back half, we might be able to, increase our growth rate.
And what's your view on hedging? How do you approach that? Do you take a kind of a dollar cost averaging approach? Do you put some science behind it to cap your risk but leave upside? How do you think about that?
What we like to do is put a minimum of 25 to 35% for a rolling 2-year time forward on both crude oil and natural gas. And why we talk about that is that then we're always at least we've got a base level of our capital program covered from a cash flow perspective, and we'll look to take advantage. You would like to think it is systematic. It isn't systematic, other than that as a quarter rolls off, it's systematic, and that whatever's into the future, we'll make sure that we top it up to that 25 to 35%. And we do through a combination of either fixed price contracts or collars. We don't get any trickier than that, or you can get much more funky with that, but that's what we do from a hedging perspective.
So you got options if oil does decide to rebound in 2026, more or less. It's good to have options, and the debt is also going down, I think.
Yeah, totally.
Maybe some questions from X before we get to current events, if that's okay?
Sure.
One or two. This one comes from Nick Duquette. As the 5th largest natural gas producer in Canada, how much time do you spend thinking about optimizing revenues from natural gas? We kind of already talked about it, but do you consider it much?
Oh yeah, for sure we do. I mean, just to, and that you're optimizing your natural gas price. We are where we are. The market is the market. So And what we deal with in Canada, very different than the United States. We deal with this summer-winter split. Summer is weak prices, winter stronger prices, to blend those together. So what we always look at is some of our best time for hedging is coming into the winter months. Here we are in mid-November. We really, in Western Canada, we haven't really had a winter yet. We're getting a bit of a winter in Western Canada, but we'll take advantage of these markets. I think we're trading at 317, 318. We'll take advantage of these markets for next year and put more hedge price contracts for next year and into 27 for full years out. So, but as I talked about earlier, as far as from an optimization perspective, we're looking all over where we can sell our product for the best prices, whether it's into the U.S. mid-continent, whether it's into LNG projects, whether it's into the oil sands projects. We're always looking for optimization opportunities.
This one's from the guy named Dividend Dave. Grant has discussed his desire and expectation that the dividend yield will compress over time due to share price appreciation. The income investors typically seek a reliable and growing dividend. Does Whitecap intend to grow the dividend over time, which we've already kind of got into? But
yeah, no, for certain we do. In the right pricing environment, we'll look to grow the dividend. I think that it is a component of, growing your business and having an opportunity to grow your dividend for shareholders. I don't want to be stuck at 73 cents forever. We'd like to continue to enhance that. But the backdrop of that is you want to make sure that you've got your appropriate level of leverage, which you're comfortable with longer term. So from a debt perspective, a balance sheet perspective, and your growth rate into what area and how much of your capital you're putting into your dividend, how much of your cash flow you're putting into your dividend versus into your growth rate. So we'll measure all that, but yeah, for certain, we'll look to grow our dividend into the future.
This one's from Rob Aiken. Has there been any discussion with government agencies lately regarding the carbon capture assets? Do you see it as a competitive advantage by being further along than your peers in this area?
I'd like to think, we had thought for the last 10-year period of time, it was a big advantage. What is never realized, it's never been realized in our share price. I mean, we have the technology. We are initiating conversations again with the new federal government as to some of the things that we believe can be done, but very preliminary. This is the other, under the other leadership, previous leadership, they wanted nothing to do with using carbon capture into partially depleted reservoirs. We've opened that file again at this particular time.
That's good for Whitecap.
Yeah.
Good for shareholders.
Yeah.
This one's some oil money. What plans does Whitecap have for the Cardium Unit number 11 in your partnership with Obsidian and Pembina?
Well, we'll continue to develop that. I mean, I think our working interest there is 66 2/3. We'll continue to develop that resource as we advance through time. We've got some very strong operators out in that area, and we've been able to extract a lot more value. So we'll continue to grow that asset. Not at an explosive pace, but we'll continue to grow it as we advance forward.
Todd Allen Lewis asks, does Whitecap or are you considering a New York Stock Exchange listing?
We aren't. As a matter of fact, Barron had a listing, and we didn't carry it forward. We looked at that relative at the time, the benefits, the pros and cons of being on the New York Exchange, and we just couldn't see that it was beneficial enough for the cost. It is pretty costly to be on the exchange, and if there's one time you could get off is when we put the transaction together. So we got off that until that would be well into the future before we looked to go on the New York Exchange.
And one more, if that's okay?
For sure.
From Jim Ricard. Does Grant see a trend towards industry consolidation and the dominance of 3 to 4 approximately million BOE a day producers?
I do think consolidation continues. I do think this is from a personal bias perspective. I think it is important that the junior sector, to spin out assets into the junior sector, is important as well, because that's the entrepreneur. That was the entrepreneur in me, that I always wanted to make sure that these assets weren't frozen in time. That I believe that consolidation is going to continue. And I think that you're going to see more American companies coming up here if we can demonstrate that we've got a friendly political environment to work off of. And I'm not sure we're there yet, and we can talk a little bit more about that. But, I think that from a consolidation perspective, we're not done yet. We're not done. And we know we're not done yet. So with Whitecap Resources either.
I think a lot of people would like to ask you about that, but we'll move on to speaking of current events, maybe, and politics. So there's been changes at the federal government level with special project announcements and whatnot, but at a high level, are you a little more optimistic these days?
Yeah, um, that's a load. Anyway, the last 10 to 11 years, we know that in our energy sector, I think it's been a grind for all Canadians, but it's been specifically a grind for the energy sector, especially with the backdrop of the federal policymakers working against our sector, not with, but directly working against us, rather than celebrating it for what it is. We are penalizing Canadians. At this point, I can say that those involved in our sector are feeling a little better about the direction the federal government of Canada is going. Yet we need to see if there is a true willingness to allow us to develop our resources and monetize into the U.S. and world markets without a discount. That means we need more egress. We need more pipeline capacity. There is a need to set policies in place that allow the energy sector to attract, I should say, investment, capital, and grow our resource sector, providing benefits for all of our people. And I referenced this earlier. It's for the benefit of all Canadians. It's not for the benefit of a few that work in the sector.
Mm-hmm.
Can it be done? Absolutely. We just need the support of the federal government to create the supportive regulatory environment to allow us to make it happen and unleash the full potential of our country. The time is now to stop talking about the energy superpower and make it an energy superpower.
And with a stable regulatory environment, do you think that would attract more American investment up north and potentially more buyers and more activity in general?
I think overall, not just investment, I think there's, with a stable, considered to be a long-term stable environment for resource development, you'd get investment, not just from the United States of America, you'd get Canadians investing in the sector, you would get we'll call Asians investing in the sector. Middle Eastern companies are over here looking for investment at this particular time.
Mm-hmm.
I think it is, but we've got to get this right and we've got to advance forward. Time is not on our side. We're going to have to develop these resources. What I mean by that, our political time is not on their side. People are starting to get frustrated.
You may be supportive of all special interest projects, especially when it comes to energy, but is there one or two that you feel are more important than the rest, or are they all important?
Yeah, I think they're all important. I personally of the mind that because we're continentally connected to the United States of America, I think that a north-south pipelines access to what we'll call a corridor, which includes oil, natural gas, electricity, condensate, I think north-south should be a priority. Yes, we're trying to build to the West Coast, and yes, we're talking about building into the Hudson's Bay, into Manitoba and stuff like that. But because of the nature of what the United States of America is, we have to make an admission that this is the most powerful country, most powerful economy in the world.
Ever.
We better link up with them. And why not? We're continentally connected. There is an imaginary border between the two countries. It's amazing that we're talking about elbows up. I don't agree with that.
And on the flip side, do you see it maybe as opportunity now? There's been some big private equity funds that have been raised. There was a big one a month or two ago. Do you think that maybe there's opportunity ahead as a result of the low interest levels the last few years?
Oh, for sure. I think that, I mean, there is a lot of private equity capital looking for opportunities in Canada at this particular time. But what we're also starting to see is publicly traded companies, larger publicly traded U.S. companies are looking, that they're on the hunt in Canada as well.
And because maybe for investors, again, their inventory has been decreasing, tier one shale inventory. And so Americans are potentially looking up north.
Inventory here for sure is far more immature and potential than what it is in the U.S. I mean, all our shale basins are getting tired. They're into their second and third tier opportunities, and we're not even getting into our first tier opportunities as yet.
Well, that's current events. Maybe as we get towards the end, some thoughts on your career, if that works for you.
Sure.
Been around the road a lot through the years. A lot of investor meetings and stops around the world. What's your favorite stop on the road?
Well, that one's interesting. I think that, the Canada used to be, Eastern Canada used to be, you'll call it the west coast of Canada, and getting into Toronto, Montreal are not friendly to the energy sector any longer. Definitely the United States of America into, Boston, New York. It's always an interesting time getting there. I think one of the predominant areas with the largest funds in the world is in the capital group out of Los Angeles and San Francisco. That's always a good place to be. Europe, I think, is coming back slowly to investing in Canada again, but definitely Asia. What I talk about in Singapore, Australia, Japan
Hmm.
are looking in Canada, and those are always interesting because you learn more when you're over there about their economies, and we have a pretty good handle on what happens here in Canada and the United States. But when you get into international travel, those are always enjoyable to. It's hard work because it's a lot of travel and a lot of we call it airplanes and hotels, but you
Yeah.
learn a lot when you're over there as well.
At your stage of your career, you're not really in a position where you need to sell, but nevertheless, you're the CEO of a company. So, what is your value pitch to investors nowadays? What do you tell them about Canadian Energy and Whitecap specifically?
Well, Canadian Energy, I mean, we're just, as I say, I have no problems in reading toting the horn of what our resource sector can do from an investment perspective. If they invest in the sector, they're going to do well. Not only one for the dividends, but they're going to have a lot of growth that comes out of Canada. And I really believe that that with this next generation of leaders that we're developing, when I think about the young, what I call the 40s group in our organization that are able to carry this thing forward, and with new technologies as we advance forward. I mean, we have to be very thankful. And what I can talk about is I've referenced a few of them before, the business leaders that throughout my working career, the guys like Jim Bertram and Keith McPhail
Yep.
and Bob Dorrance and Mike Rose, and whether they were Arun Chandrasekaran and Jeff Lawson and Glenn McNamara that are on our board. But these were all, kind of visionaries and have been visionaries. And we're handing it off now to what we'll call the high 30s and the low 40s group, that they can carry this thing forward for many years to come. And that's the exciting part about it. I really believe that that we're not anywhere tapped out in Canada. There's going to be lots of opportunities and encourage more and more, we'll call it high school to university kids to come into our sector because it's going to be around for a very, very long period of time. They're going to be able to, when I call it, I'm up for the challenge. I think these young kids should be up for the challenge, and making Canada a superpower. We just have to get our federal government to support what we're trying to do.
And speaking of excited, you haven't had to work for a while, but what motivates you nowadays? What gets you out of bed?
Yeah, motivation's an interesting one for me. From an overall perspective, I think I referenced it earlier that I do enjoy the thrill of the hunt. I think that, and working with good people,
Yeah.
alongside others that we can continually improve. I mean, like to look at, 3 months, a quarter, 3 months at a time, a quarter, a half a year. How do we enhance the asset quality, improve our efficiencies? Growth for growth's sake has never been my mantra. Um, However, growing value for shareholders has been what I'm very excited about. And having our young professionals, it's exciting, to watch our, young professionals and support staff build financial independence for themselves and their families. And I think that is the biggest enjoyment that I get. It's very powerful. It's humbling to see how intelligent people are. And totally, to be honest with you, my motivation, that's what I love about our business.
At your age, at the stage of your career, you could take your capital and put it into the market and clip a nice dividend coupon and sit back and watch TV, basically. But you've decided to keep major skin in the game. I think you just made a major buy in October of shares. You own over 3 million shares of Whitecap. You have skin in the game. You get up every day and you consider and you go to work. Do you view it as a value add to Canada's continuing to build a company and employ people and give back capital to investors?
I do. I do. I really think that I do get up. I'm excited early in the morning. Excited about the opportunities that we have in front of us. Yes, there's lots of challenges, but it's far outweighed by the opportunities that we have and being able to develop. So yes, I own,
Good chunk.
in essence, I'm over 3.5, about 4 million shares at this particular time, and I believe you have to have skin in the game in order to to make change or to be able to drive it forward. So it's exciting. I think I'm very excited about our sector, and I'm excited about what it can provide for, people of Alberta, people of Saskatchewan, but ultimately people of Canada.
What's the advice that you remember Doc Seaman giving to you when you talked to him that day? And on the flip side, what advice would you give a 30-year-old Grant Fagerheim?
Yeah, I think, you know, um, I think it's important to ensure that you team up with like-minded people in your organization, those that are prepared to work hard. Nothing's for free. You're always willing to take on additional workloads, whether you're not proficient at it or not. Um, Collaborate. Um, Remove yourself from the credit grabbers. Um, be honest. Maintain flexibility to adjust the company's plan to an ever-changing energy environment, high price environment. And I, talking about enjoying your work, if you enjoy your work, I think about it in this context. I call it a perpetual success cycle. If you feel good about doing your craft or your work, you'll probably spend more time doing it. When you spend more time doing it, you put yourself in a higher probability of success. And that becomes an endless, perpetual, you don't want to fall out of that. So working hard, enjoying the people you work with, have some fun doing it, and making sure that you're honest, you're fair, you work hard, but you got to enjoy what you're doing as well.
And do you remember what Doc Seaman told you that day you met him? What was his advice to you?
Yeah, he said, from my perspective, he said, as I mentioned before, you're in the energy epicenter. Enjoy yourself, get with good people, and go make it happen.
Well, I think that's a great place to leave the conversation. I really appreciate your time.
Trevor, thanks very much. Appreciate it today. Thank you.